Things are about to get a whole lot worse for the Canadian real estate market, according to one of the world's largest credit rating agencies, Fitch. According to the latest report, there's a major risk right now in the mortgage bond market, and based on its analysis, Canada is expected to experience one of the biggest busts when it comes to real estate as prices correct around the world. Canadian real estate prices saw one of the largest run-ups in the world. Yes, compared to every single country, Canadian real estate saw one of the sharpest climb in prices, with prices climbing 41% from 2020 up until the peak of February of 2022. Which is estimating that even with the fall in prices in 2022, home prices are still overvalued by at least 29%. With surging inflation, falling home prices, and interest rate stabilization, they're expecting prices to continue to fall in the coming months. And when it comes to Toronto and Vancouver, the overvaluation is still expected to stick around, just take a large hit post-correction. If you are on a variable rate mortgage, you've likely seen the brunt of the impact of these rising interest rates. It's estimated that the average increase in monthly mortgage payments for those on variable mortgages, you've seen your mortgage payment go up by around $7 per month. Now, those of you on fixed mortgages, you haven't seen that big of an impact. It's estimated that the average fixed rate mortgage has gone up by around $300 a month. It's estimated that those of you who have mortgages, nearly 70% of mortgages are on 5-year fixed terms. There's only really a small segment of the market that is immediately exposed to these sharply rising interest rates. And if you have seen your interest rates rise and you are seeing your mortgage payments go up, one option to consider is extending your amortization period. This will help at least mitigate some of the impacts you're seeing from higher mortgage payments. But despite home prices falling, Canadian real estate is still expensive because whatever we've seen in terms of price drops has been pretty much offset by rising interest rates. It's currently estimated that we're only in the middle of the sharp correction, and this correction is expected to continue all throughout 2023. As of right now, compared to February of 2022, home prices are roughly down 15%. And according to the Canadian Real Estate Association, prices are expected to fall at least 6% in 2023 compared to 2022. Now, here's some forecasts from the big banks like RBC and TD. Firstly, RBC is estimating that prices will fall in 2023 by at least around 8.5%. And TD, they're projecting close to an 11% decline in 2023 compared to 2022 in home prices. And to really put this decline into perspective, I think it's important to look at the hard data. And we actually have data from the last 100 years to compare against. So take a look at this graph. We can see that our current forecasted decline is pretty close to what the country saw in the late 70s/early 80s. But what's really neat is in that period in the 70s/80s, the housing market saw straight 4 years of decline during that period. And right now, we're only in the first year of this correction. And based on all the forecasts that I'm seeing, this decline is expected to continue. How long it'll last? Well, that's up to anyone's guess. And the way Toronto and Vancouver prices went bonkers the last few years, honestly, a correction is more than welcome. It's actually healthy for the economy. But that situation for prospective buyers is not really improving. Despite home prices falling at least 15%, the mortgage payment required to buy a home is higher today than it was a year ago, than it was 2 years ago. And that, of course, is because of these higher interest rates. And I know I've said this a few times over, not just in this video, but in other videos as well, that the drop in price we've seen so far is completely offset by these rising interest rates. In fact, we're actually more unaffordable today despite home prices falling. And to really drive this point home, let's do a real-life example of what those numbers actually look like to make my point. The price of an average home right now in Canada costs around $700,000. Let's use that as part of our example. And let's say you're putting 10% down. And based on current interest rates, you're going to get likely a mortgage of around 6% or so. So what does that mean? Well, when you do the math, that means your monthly mortgage payment on 10% down and a 6% finance for the rest, your monthly mortgage will be around $4,100. That's with that $70,000 down and a loan of $630,000. Now, what's really interesting is that interest rate 6% and you're taking out a $630,000 loan, over the life of this entire mortgage, you're going to end up paying over $1.2 million back to the bank. That means you're going to pay double what you borrowed because interest rates have gone up so drastically in the last few years. Now, if you were using the same example last year, your monthly mortgage payment would have been around $3,800 compared to $4,100 today. In order to get that monthly mortgage payment down, you'd have to put down at least 20%. And at that point, you're looking at a monthly mortgage payment of still $3,600. And if you go back further still, just before the pandemic hit, and if you were using the same example, your monthly mortgage payment would have been around $2,300. That's a far departure from today's interest rates and today's expected mortgage payment of $4,100. That's almost double the price that you have to pay in your monthly mortgage payment. Your income, I'm pretty sure, hasn't doubled up since that period. So where does all that money come from? Well, you're now squeezed because of a higher interest rate. You're now squeezed because of high inflation. So monthly budgets are just getting squeezed for the average Canadians. What these numbers really show is how much of an impact these rising rates have had on monthly mortgage payments. So just when you take a look at things at face value, home prices falling, while that drop in prices isn't offsetting the rise in monthly mortgage payments. And at today's interest rates, home prices will have to fall at least another 33% to see monthly mortgage payments that were around just before the pandemic hit. And sticking with that thought of prices falling by an additional 33%, again, your hypothetical example, at that decline, the country would have experienced a massive 45% drop in prices from its peak of February 2022. That means that if we were to see that type of decline, prices would be down to 2012-23 levels. Now, is that really expected to happen? Probably not, but what it does is that it put things into perspective when you take a look at these hard numbers. Now, the numbers we just took a look at were just to illustrate the point of how much these rising interest rates have had on monthly mortgage payments, which has completely offset any drop in home prices. Now, of course, your personal situation, whatever mortgage you have, whether it's a fixed rate or whether it's a variable loan, or where you are in the country. For example, the Prairie's real estate market differs from that of Vancouver, which will differ from Toronto, which will differ from the Maritimes. Your local situation, your personal situation will differ from this example, but it's just to give you an idea that when we say that home prices are falling in Toronto and Vancouver and parts of the other country, it's not really helping make things more affordable. But one thing is absolutely clear when you take a look at these numbers. The two biggest real estate markets in Canada, Toronto and Vancouver, they are still not affordable for first-time buyers. And let's say you're making an average salary according to Stats Canada, which is around $60,000. Your monthly pre-tax income is around $5,000. And after tax, you're looking around $300 a month or so. At that income, assuming you have no other bills, you still can't carry a mortgage of $4,100 if you're buying an average size home. Reality is you can't just take your entire monthly after-tax income and put it towards a mortgage because you have other bills to pay. You have maybe car payments. You definitely need to put food on the table, clothing, various other bills. And it's important you do this type of math to really understand how much of a home you can afford. Or not just how much of a home you can afford, where you can afford the home is just maybe, if not more important. I'm constantly asked, what should someone do as a prospective buyer in today's market? Well, my response is that you need to do the math, plain and simple. See where you can afford, see how much you can afford. And after you pay your mortgage, do you have money left over for essential items? Do you have money left over to even save for retirement, to save for a vacation, to save for other life expenses? If you are stretching yourself to the max or even stretching above the max, it's not really going to help your situation. The reality is, if you want to live in Toronto or if you want to live in Vancouver but can't afford to live in Toronto and Vancouver, reality is then you can't live in Toronto and Vancouver. Consider the situation of any borrower who bought a home in the GTA in early 2022. Their home could be easily worth less by 15 to 20% today. And if they put less than that as a down payment, they are underwater, meaning their mortgage is actually larger than the value of their home. And that's why it's so important that when you do your budget to see how much of a home you can afford, you need to give yourself as much wiggle room as possible. Clearly, we need more housing supply to make things better across the country. But given the situation we're in where we're actually seeing home prices falling and worsening affordability, we 100% need better public policy from our governments. They need to be more proactive rather than the reactiveness we've seen. Even though housing prices have fallen across many markets in Canada, you cannot take that at face value. Housing costs remain high and affordability is significantly worse today than it was a year ago, than it was 2 years ago. Things have definitely not gotten better. As elevated home price and the rising interest rates have kept many Canadians priced out of the housing market, several individuals have turned to the rental market. Because of high demand and high price in the rental market, things aren't that much better in this segment of the market either. The rental market today is unbelievable, and part of that was driven by people hitting pause in the housing surge, because if you can't afford to buy a home, then you're trying to at least rent because you need at least some form of shelter, whether you own your home or you're renting. So that has driven the rental market to insane levels today. But a lot more recently, there is an expected boom in immigration and non-permanent residents expected to hit the country. And people in this category tend to hit the rental market first. So not everyone is rushing to buy a home right now. But who is rushing out to buy properties are investors who are scooping up rental properties to add to their portfolio because of this expected immigration boom. A lot of investors and potential investors are looking at these potential immigration numbers and they're going like this. They're going to be making money as this inflow of people come in and start looking for properties to rent. Let's take a look at Facebook, take a look at Gigi. They're so-called these landlords who are going to be cramming as much people into small places as possible to maximize their own dollars. I'm constantly seeing one room being shared between 2 or 3 people, and each person is paying like $1,000 for half a room or a third of a room. That's insane, and that's the state of the rental market today. And this is really pushing rents up. Take a look at some of these numbers. Toronto's rent is up 20% compared to a year ago. Vancouver's rent is up 24% compared to last year. Even areas outside Toronto have seen their fair share of rapid price increases. Burlington, Mississauga, Guelph are all up around 17 to 18% compared to a year ago. Victoria and Kelowna, BC are all up around that same range. And if we go further down this list, it doesn't get much better. Kitchener and London are up 26% versus last year. What's really interesting is when you look at some of these percentages, this is what the home ownership market saw a year ago, 2 years ago, when home prices were going up like 20, 30%, and now those same percentages are hitting the rental market. Things have really shifted towards how bad the rental market is getting. One of the very few places left in Southern Ontario that has some level of affordability is where you can get a 2-bedroom for less than $2,000 is St. Catharines, Ontario. And where will you get the lowest rents in the country? Well, as of right now, and that's the Prairie provinces. As many Canadians struggle with housing affordability, the country's immigration policy and housing construction are completely disconnected. You have the federal government and provincial governments driving up population growth through immigration, through non-permanent residents. And they're doing all this without actually taking a hard look at what's happening in our housing market. The country's largest province, Ontario, needs at least 2.5 million new homes over the next 10 years just to keep up with the expected immigration boom. And in order to hit that target, Ontario needs to build 3 times more homes than it's currently building right now just to keep afloat. So this is our challenge today, and that's why you've seen insane growth in both rental prices and housing prices over the last few years. It all just boils down to the imbalance between how much supply we need and the expected demand that we're experiencing today and the expected demand we're going to experience tomorrow. There is a huge imbalance in the supply and demand game. While many Canadians have been waiting for this housing bubble to pop, we haven't really seen people exiting the housing market, and this has been putting pressure on the housing market, especially in the GTA. Typically in down markets, you expect investors to exit the market quickly, and they're usually the first ones to exit and put their properties up for sale. We have not seen this in the GTA and the Greater Toronto area. This has kept the ceiling on the number of listings in the housing market and has kept the Toronto housing market quite competitive today, even though sales are near 20-year lows. And because these new listings are at 20-year lows, that's the most interesting dynamic we're seeing in the housing market right now. Drastically low sales, ceiling on the number of new listings, and where we are seeing some relative activity, the prices are falling, but there's sort of a floor and ceiling between for the housing prices because you have immigration boom, you have these rising interests. So there's a lot of things that are happening in the housing market right now. There's a lot of dynamics at play that's going to impact where the prices go next. Prices have been relatively flat in both January and February, and it's because of all these dynamics at play that's creating this weird floor and ceiling on the housing market. We're not seeing the same downward pressure that we saw in prices that we saw in 2022. And I'm sure you've seen the headlines and all these media outlets reporting that there is a huge expected immigration boom expected to hit the country. But have you wondered why Canada is so focused on bringing all these people into the country when we're facing our own set of economic and housing challenges? Well, here's the scoop. Canada faces a major challenge right now, and that's not entirely related to interest rates. Canada is ramping up immigration because of its aging population. If we don't get the influx of people that we need, the Canadian government is projecting that we'll need to pay more for social services and for our healthcare. And let's face it, today, these social services are not that great either. You're waiting for 5 hours to see a doctor in the emergency room. So the healthcare situation isn't really that great. But can we really solve this issue by just cramming more people into the country without focusing on the infrastructure first? So we're kind of doing things a little bit backwards here. We're expected to bring people in without focusing on the housing needs. Or bring people in without focusing on our infrastructure handle this influx of people. Bring massive amount of people will surely bring up tax revenues, but in the meantime, until you see that increase in tax revenues, who's investing in the infrastructure? Who's investing in the housing sector? So what does all this mean for Canadian housing prices? Obviously, no one can predict the future, but what we can do instead is keep an eye on key factors that will definitely have a large influence on where prices go next. Number one is immigration levels. Are we seeing immigration levels come in at the expected targets that the government has set out? 2 is interest rates. Will the Bank of Canada continue raising interest rates? Will they hold them steady? Or will they start cutting interest rates if we hit a recession in late 2023? allocation of funds from the budget from the federal and provincial governments are going towards these healthcare sectors, towards the education sector? Are we underfunding these critical core area of services that we're trying to fix by bringing more people into the country? I'd love to hear your thoughts on all these factors at play that are going to impact the housing market. Let me know your thoughts in the comment section down below. Where do you think the prices are headed? And can we really fix our problems today just by cramming more people into the country? Let me know. Thank you so much for watching and making it to the tail end of this video. Your continued support means so much to me. There are exclusive offers for you to grab in the description of this video, and it's just another way for you to support this free content. And as you're doing that, you can pick up some amazing deals and discounts and sign-up bonuses for products and services that I use on a daily basis, and at least, you can try them out. Also, don't forget to hit that like, subscribe, and thanks button on the bottom of this video. That's it for now, and I'll talk to you in the comment section.